like to start off with a yawn. Had a kids warm me out at practice tonight. We had 2 back-to-back scrimmages. We're getting ready for some games this weekend. Got a new exchange student from Sweden. She's a central midfielder, big, strong player, very gifted, soft touch, sees the game, great team player. Boy, it's just fun to play with people that know how to play. Had a good conversation today with a number of the veterans of previous annual research weekends. And what we're going to do is record a series of responses to trading in the time of the virus, how folks have been adapting and overcoming in these past 6 months, with check-ins on, what they've been doing, what the stats are, what adaptations they've made, what they've learned, and what their next steps are going forward. And we had some really positive feedback already. A lot of it on the psychological side, as people are making adjustments to their lives and their outlooks on life in view of the virus. And we shouldn't overlook that as an important component of the total trading system. So I think what we're going to do is get those folks to record some virtual presentations between now and November 15th. We'll publish a batch of those and then leave it open for about a week for people to ask follow-up questions. And I will arrange a second round of Q&A sessions for those folks. So we will assume that people have seen the videos and then can come to the Q&A sessions, and we'll queue that up and call that the virtual annual. For an example, I'm going to try to get Jerome Gonzalez from the Philippines to tell us a little bit more about his trading adaptation for the swing trades that he's been doing on the 65-minute charts, which I showed yesterday, and just an amazing, he's got about a 95% return on equity this year. Which ain't bad in the time of the virus. Ain't bad at any time, to be honest. Well, let me before I go any further, let me try switching to a different connection. See if we can make a difference. Elon Musk at SpaceX has they put up another 60 satellites, and now the coverage from Starlink is coming down to the Iowa border. So we're almost within distance. I hope they hurry up. Let me get this connection changed. Stand by. Stand by while I fix the crash. Market check again, if you don't mind, with your permission. All right, so today we had a clear vote upward, made a new 30-day high. It broke out of the yellow zone with a gap up, and it held support at yesterday's high, and then closed strongly. Very tight range. The smallest range of the last 30 days was today, so we're going to see a lot of dojis fire. Made new 30-day high. We've left the 10-day low behind and further leaving the 30-day low behind. We're within charging distance here of the Z1, and then if that Z1 breaks, then the next is the peak of the dragon at 350, and then from there it's the baby dragon, and then the peak of the RL10 up here at Z2, and this is 354 and 356 respectively. So we've got some free running here. We've got an open field that's ready to go. On the other hand, after a nice move off the bottom, we should be prepared for markets to take a pause here. There was not a lot of, runaway buying pressure which I don't think we should expect. But this is a nice move off the bottom, so I'd be looking at preserving. Possible stops here are the low of the day at 341. I would say the Bollinger Band mean at 337.5, which coincides with the skin of the dragon. So I treat that as a very strong support level. Like, if you have a position on the long side that's in the money, I would not let it go into the dragon. I would stop there at the Bollinger Band mean. So you have the skin of the dragon, spine of the dragon, lower skin of the dragon. You would then have the Z1, and then tomorrow's PSAR here at 329. The belly of the dragon, which lines up with today's PSAR pretty well, 327. Then the belly of the RL10, 10-day low in Z1 or Z2, and then the 30-day low. So I would look to be preserving at least this much of that move. I think I would have my stop in right here on a swing basis. Like, I'd be willing to give that much wiggle room, but no more than that. And I wouldn't be offended if you decided to be even more ruthless on your risk management and looking to preserve yesterday's move as well. That would not offend me. Let's shift to today's sectors and see what we got. All right, so the S&P ground out a pretty good day at 0.83%. It was better than Treasuries, which was 0.5. Better than where's the diamonds? Which was better than the diamonds at 0.42. And then the best performing U.S. index here was the Russell at 1.22. All right, sectors that were better than the S&P. Clean energy was slightly better, as was materials and finance. But then we got a decisive moves up in oil at 2.7, and then the pair of Mexico and Brazil at 2.3 and 3% respectively. Energy and oil exploration 3.8 and 4.3, and then Devon crushed it with a 4.56%. Other significant companies, so you got Devon, Alcoa, DuPont, Goldman, Cliff, Boeing. So all of those are even better than the triple techs. So you've got the TQs at 1.6, TECL at 1.5, and you don't see the first tech company until Google and Intel here at 1.7 and 1.5. So this was really a day for energy and some of these internationals, even defeating the tech sectors. So and we're going to see some really nice trades in Mexico here, and it will serve to explain why we love frog champions. Frog champions are great trending symbols intraday for frog systems and also as swing trades, and that's Brazil and Mexico both fall into that category. All right, so things that underperformed the S&P today. So we start with the S&P again in review is at plus 0.83. So then you had close but not quite as strong emerging markets, consumer discretionary, and wheat and precious metals like 0.6 to 0.8. You had tech and healthcare at 0.5. The FANGs, which is Facebook, Amazon, Apple, Netflix, and Google, at 0.4. Silver at 0.4. Getting down into the negative territory then. We have Japan at minus 0.8. Simon Property at minus 1.3. So most of the sectors were tightly clustered around the S&P today, with the exception of outperformance in basic materials, finance, and energy. So the three the three others were the big winners today. And for those of you, I see a couple new faces in here. So just as a reminder, the reason we pay attention to those so when we see, as we're tracking the S&P, and right now, XLK technology has been the long-term strong sector among the XL series. So anytime the S&P is up and XLK is up even stronger, that just reinforces the broad narrative. That was not quite the case today, because as you can see, the S&P was at 0.83 and tech was at 0.5. So today bucked the trend a little bit, where XLK was still up, but it was lagging the S&P. But on the other hand, what we had in the sector cycling symbols, we had energy, XLE, very strong, and then F and B, finance and basic materials, were both stronger. So these have been, if this was normalized S&P, we've seen these other ones moving like this, going through this kind of sequence. Well, XLE, F, and B have all been underperforming, but now today they're outperforming. So we want to see if there's another day of gains still available, and that means that we would look, we look for those leading companies to continue to perform. So that leads us to studying Devon, Alcoa, Dow, DuPont, I should say, Cliff Natural Resources, Nucor Steel. Those are all going to be ones that are on our short list to look for continued follow through tomorrow. Okay, so that's why we care about that. Yeah, that's what I'm going to look at there. All right. Just a quick update. Procter and Gamble, we've been following this as a long-term swing. And, the thing to note there was this previous circle was the peak before it broke down, before we had the big breakdown in, with the virus, and it got down to this sell-off. Pretty strong V recovery, almost got all the way back. The pullback was small, held support at the RL90, and then we get a supported spring crossing here, and then a second position here when it breaks out above the previous Z3 channel. And then really, once it is cleared, this previous peak, now there's no resistance overhead. This thing is just working nicely. And now the that little 10% pullback that we had earlier hardly even phased this. And now we've got a nice breakout starting to happen again right here. And so this could be free and clear. So I take this to be a very favorable moment. The start of the next change. You see, we've got a PSAR flip has occurred after a Z3 pinch, and there's no resistance overhead, and they pay a nice dividend. And we're going to notice when we get to the daily report that Procter and Gamble is still leading the way upward. So this is a very powerful move. So if we think of this, we could look at this as leg 2 even. If this is leg 1, leg 2 was decisive, pause, and possibly the start of leg 3. This thing could get to 160 without much strain. It's a defensive sector. it's household and personal products. I mean, there you are. The other trade that's in this long-term swing space is PBW, and this first run up here into end of August um, sold off, but has held support pretty well. And we got the Z3 breakout here, and we've been building swing positions. Yesterday, I put in the stop here at 68 to make sure we locked that in. That got broken today, and it closed slightly below there. So that swing is over. But this is the reason why when you see those strong relative strength moves that have an orderly pullback, I now want you to notice this is probably the next kata that's coming up. Is this pattern here where you have the swing low and a higher low in the RL10s combined with that summer moving out and either a Z2 or a Z3 breakout. When it clears the previous peak on a Z3 breakout, that makes this a really strong move and a resumption of the previous trend. And so if you take a look, PBW is up something like 60 or 70%. It's been a member of the long-term core portfolio, and we've been supplementing that with turbo trades on the swing and the day for the last 3 months. It's getting strong support from European buying as well as domestic. And if you think about the Green New Deal being a real thing, how do the Democrats, when they win, how do they not support that as a way to rebuild U.S. infrastructure, rebuild skills in an emergent technology, and combat green? It's kind of a no-brainer. So I see PBW being a central player in that ecologically sustainable growth ESG trading style coming up, and should be a clear winner after the election cycle plays out. So that one, however, what I would say is you still got to pay attention to price and respect the price. And so a stop here at like 68 locks in these three gains, and I know how to re-enter. So what I really want to do is see where in this stack it's going to retain support. I would like to see it find support north of Z1 or the spine of the dragon or this RL90. So if it pulls back and then starts to resume, I will be back into it with an initial swing position. But we had such good success on a very tight stop. So this is an entry at 60 with $1 stop, and that exit at 68. So that's 8R on the first position. So this would probably be 4 and 2. So that's going to be in the neighborhood of 12 to 14R on the swing trade off the original $1 risk. So that's nothing to sneeze at. And when you have large R multiples is when you want to be ruthless and rigorous with your exits, as we have been discussing lately. Okay. So that's that. One of the reasons to be interested in swing trading and hybrid trading is just this reality. So I have a lot of respect for the guys at Young Research. They do, I think, a sensible job of blending some market timing and longer term asset allocation. So Young Research and Publishing has a pretty good reputation with me and in the industry. And so they just published some updated material on the various portfolios that they recommend. And I kind of look to them for doing the due diligence on longer term buy and hold and some dividend producers. Like yesterday, I showed this one. This is their analysis of the high yields that are also reasonable, investable symbols. So a lot of times you get a high dividend payoff when somebody that's been paying a dividend has a problem in their business cycle and just got crushed, and so that throws their dividend percentage up high, but it doesn't mean that's a sign of strength. You want to take a look at a sound business process with free cash flow that also pays a dividend, so that you have some belief in the health of it. So this kind of met their screen for symbols that are in that category. Well, that same approach leads them to study different blends of asset allocation, and this is their look at the current update to the efficient frontier. So the efficient frontier is that frontier which says that if you're anywhere on that curve, that's the best combination of return percentage annualized versus the amount of risk that portfolio takes as a function of standard deviation of annual returns, compiled over multiple years. And so the current efficient frontier, which is based on the 7 to 10 year, the midterm treasuries, and then the total return of the S&P for the last 40 years, shows that if you're holding 100% bonds, you've annualized an 8% return, but with a 9% standard deviation, meaning that 2/3 of the time your numbers are going to be plus 17 to -1 if you're holding all bonds. So that's, when the standard deviation is greater than the return, that's hardly the risk-free rate of return. Whereas if you blend that with 25% stocks, you actually get about an 8.7% return at only 8.5 standard deviation. So you're actually improving the return at lower rates of volatility. And then when you start looking at the different mixes of stocks, like a 50-50 stock and bond gives you 9.4, but at 10.4 standard deviation. And if you bump it up just a little bit more, you get 9.6 versus 11.5. And so somewhere in that range is probably a reasonable expectations for models. Now, we talked about this over the weekend. Like, how would you like to be the CalPERS retirement account manager? He's trying to manage $400 billion, and he has to have half of it in bonds, and he has to return 7% on $400 billion in order to break even on the management of liabilities for payouts. And the 8% return in bonds over the last 40 years, this is the only time when we're experiencing zero rate of return on bonds. They're paying zero essentially right now. So that means half his portfolio is earning zero. And so that means the other half of the portfolio now has to earn 14%. And that's so far off the chart on returns. You got to say, how in the world is he going to do that? And now here's the problem, for example, on Apple. The dilemma of Apple for investment managers is this. They have been so successful that Apple has been dragging the S&P and the NASDAQ north far beyond the ability of commercial money managers to exploit it. So if you're a fiduciary, you probably have limits on the maximum size of any one component of your portfolio. Well, nobody can afford to own enough Apple as a proportion of the S&P because it's greater than what they're allowed to own. So they can't match their own holdings of Apple to what the indexes return. So the indexes are crushing 80% of the portfolio managers now, because the very few symbols are contributing to most of the gains, and yet they're not allowed to do that. So that kind of puts the passive index investors into kind of a trick bag in some ways. So one of the ways that an individual investor who's not bound by the same constraints is if you have the skills and the discipline and the system, then you can start focusing on some of those gainers that commercial investors may not be able to do. So let me read this from Luis. Working at Merrill Lynch for 20 plus years, and during the collapse, asset allocation was suitable at the 70-30 mix of probably stocks and bonds. Luis is well aware of the ironclad logic of this curve, which drives most of the fiduciaries. And now some of the inefficiencies of the current market in the COVID are such that because we're not bound by the same constraints as portfolio managers, it's possible for us to exploit some of the inefficiencies that are triggered by a global market that has shorter term ups and downs. And so that brings us into the swing trade window. And that's why for those of you that weren't here yesterday, that's why when Jerome is able to achieve some effects like this, where this year through COVID, he's returned 91%, and then the 1 year rolling is 95.5%, whereas the S&P is at 7 and 17%. And it's because he's able to get some timings like this, where the Z3 breakout and the supported spring crossing here and here allow him to take advantage of very strong moves at known critical points. So very low risk and high payoff. These asymmetric returns that are available from hybrid trading make some performances like this possible. And at the same time he's getting these returns, his drawdown when the S&P was down 11% was negligible, because he can be a little more adaptable and agile than larger ponderous indexes. So that's sort of the argument for the swing trade being the central feature of hybrid trading, because it allows you to convert some of those to longer term positions. The swing trades allow you to hedge against your core positions. And then the swing trades also allow you to use some turbo techniques on shorter term time frames. Now, he's had a lot of success on his, I would call it a hybrid swing day, where he's using 65-minute charts and not necessarily the 1 and 3 minute charts that I'm using for intraday, purely intraday. But even the 65-minute chart has given him some real power on these multi-day moves. And so on a week that has featured this kind of move, those 65-minute bars have given him some real strong moves, both down, up, down, and up. So he's able to play some of those intermediate term trends pretty nicely too. So I'm looking to hear more from him on the annual research weekend. So here's one I want to cover. So this is EWW, Mexico, and here we are at the open. And I want you to see, this is kata number 2, and that's that supported spring crossing with higher lows. So we have a gap up. The RL10 bottoms out and rolls up. It moves up a distance, comes back a distance, gets support at the PSAR and the Bollinger Band mean. And I want you to notice that it has this higher low, which now makes this supported spring crossing even better, right? So you could see this one as a supported spring, and that one actually works, because if you're using the Wu Wei exit, right, that doesn't move up to the Bollinger Band mean until it gets like about three dots above. So even on the first entry, you would still get this first trade. But the second the second position, in my view, is a better one because you have the added evidence of of higher lows. So you had a swing low here, and then the RL10 bottoms out here. You get the PSAR flip, so you get long at about 34.49. And this yellow box, it's really, that's only 4 cents. 4 cents. So you might have a little bit wider because you're worried about volatility, but that's what the indication is a 4 cent risk box. So then you get 1, 2, 3 dots. This is where that the Wu Wei exit would now move up. It picks up the Bollinger Band mean here, and then it takes that nice little exit for a little over 1R. Now it fails to fail further, so it holds support above the VWAP here, which is nice, and you get the next. It turns to winter, but then winter becomes spring. So this is a supported spring crossing. And really, the risk box on this one is only a couple cents. But again, I would probably pick just below the VWAP and use the same standard risk box that I did on the first trade, just so that I have the standard position size. This one doesn't have a lot of follow through, but you get a fractional win. We get bottom ticked again. But the reason you exit that is because that's the rules, and you're protecting against a move back to the VWAP and then a move back to yesterday's VWAP. So that way you're still locking in a fraction. Then it fails to fail further, and then the fall crosses the dragon again, and here's the PSAR flip. So an entry at about 34.70. Again, with about a 5 cent risk. And this time, with no resistance overhead, this thing just runs amok up to 35.05. If you take the sniper exit at 34.95 or the manager exit better at 34.90, you're pretty happy because now this is going to return about 1, 2, 3R. So just on 3 routine trades, you're probably looking at about 5R in less than 2 hours. So from the open 9:30 to about 11:30, call it 2 hours, and that's looking at about 5R in a relaxed way. And that's not even putting the second position on in here. Now I want you to remember where that yellow dot is at 34.90 at like 11:30. So this is a frog champion, and they tend to be very directional intraday. So after that little pullback that gets us out, there's 34.90. That yellow dot is the same yellow dot you saw before. And now you have fall has become summer. The RL10 peaks or bottoms out, crosses the baby dragon. Winter turns to spring. RLXD, PSAR flip. So you buy the supported spring crossing here at about 34.88. And now when it clears the peak of the dragon, and it's still riding this nice little wave here, second position. Now when we draw the Wu Wei exit, I just want you to notice how this plays out. So again, your Wu Wei would be here. This is about 3 dots north of the of your first entry. That's when you put that in place and you wait for the Bollinger Band mean to pick it up. And now the Bollinger Band mean rides this thing all the way to 35.35. So that's about 50 cents on 5 cents of risk. So that's about 10R on the first position. So if this one's about 10 to there. So that means this one is about 6. This one is probably 3. and this is 2, so that's probably conservatively 20R on this move from 11:30 to 2 p.m. So this whole trade in here is a lunchtime move right here. This a quietude, and this is what a frog champion looks like. Once that thing starts grinding and going, that Bollinger Band mean is your friend. And so this position is indicated to add because it's above the hump of the dragon, and it takes out the previous Z3 pinch. So that's why there's no resistance overhead. This one's just a money managed one, right? So you get this move up, and it kind of stabilizes in here, and you see the Z3 is pinched. Now it starts starting its next leg up. So you put the third one in. The same thing here. The Z3 gets to a max. It starts to pinch in. It fails to fail, and it starts moving up through the previous Z3 pinch. So the fourth position is in. And now, as this thing converges and rolls over, you take a nice orderly exit at the Bollinger Band mean, and that's about 20R. So you add 5 or whatever we said, the first one, 5 or 6. That's a 25R day just in Mexico on a day when the S&P itself was not making a move. The S&P's range today was the smallest percent move of the last 30 days. And the fact that it closed higher bodes well for tomorrow. There was an absence of fear, and the path of least surprise is up. And on a day like that, Mexico just crushes it because there's no reason to sell it, and people just buying it all the way up. So that's today's lesson on what a grinding bull looks like, and why frog champions matter, and why you keep taking your shots, and why you are ruthless on your risk management. You are ruthless on your exits so that you can be automatic on your reentries because your cognitive load is so small. Okay, let's shift to the daily report. Okay, so today's we are still in bullish normal conditions. We're back to overbought on the 3 and the 10-day look back. ATR percentage came down today to 1.8. It was at 1.9 and some change yesterday, so that's good. The risk Z is tucked in right at the 0 line, ready to make a big move up or a big move down. So this is really favoring the shorter term volatility directional trading. Today it happened to be up. Tomorrow it could be different. The Latin American rebound was so good today that if there is weakness tomorrow in the S&P, and if there's weakness in ILF, then that's the way that you want to use ILF as your short-term trading vehicle tomorrow. By extension, Mexico and Brazil will also be on our radar to go short if they are showing price weakness as well. Okay. The 10-day max pains, these are the ones that have the least sell-off from their 10-day high: Caterpillar, Honeywell, Walgreens, American Express, and Goldman. The 10-day max pains, the ones that are suffering the most from their 10-day high: Amgen, Boeing, Merck, Disney, IBM. Treasury, silver, and gold. So that the whole defensive sector plays are getting smoked. And then you still have Simon Property Group, which is always interesting because, it pays such a high, it pays about a 9% dividend. So there's going to be some degree of interest in that no matter what. They own real things. Their real problem is that Trump's political games of stopping the next round of bailouts is going to place greater pressure on the small and mid-cap real estate owners and business people. And they're not going to have the infusion of cash that is going to help them make their rent payments. Well, Simon Property Group is commercial real estate. And if they don't have tenants that can pay rent, then they're not earning money with which to pay that nice dividend. And so you're seeing their stock price really go through a lot of different gyrations. So when we look at Simon Property Group here, yeah, you can see that they're they are not in great shape today. And if we look at the daily report, you can see that they have barely recovered from that massive sell-off from March, and they're locked into this really tight trading range and starting to roll over again. So this is not an encouraging place to be. So I think these are the people that are not selling it are just collecting that dividend and hoping to see business turn around at some point. But as a growth opportunity, it's just not there. You might be able to play some small swings. This is not the time to initiate. But so Simon Property Group, longer term, should be of interest to us. Okay, so the Dow 30 tactical summary next. Tons of dojis today, no surprise. We've got a channeling in Amgen and a Max Payne. You had IBM with a big win today and a big breakout. So I'm liking that one. I also am liking Caterpillar right now with its breakout on every measured dimension. And even Coca-Cola had a nice breakout on the 10-day. But let's go take a look at Caterpillar real quick. Yep, that's what strength looks like. It has completely recovered from the March sell-off and back above that previous long-term high, and no resistance overhead. So we're kind of liking that. It's in the summertime of the Four Seasons, and if we look out even further on a weekly, still really good. Now, I would say that this upper limit of 170 is in play. So that's still a 10% gain to there. But if it gets beyond 170, then off we go. There was a time when Caterpillar could do no wrong in the run from 70 to 170, and we enjoyed that. But now it's recovered all its big sell-off, and now it's poised for the next leg up. So keeping that on the longer-term radar. When you look at the weekly, by comparison, Procter and Gamble, it's not even close. Look how awesome Procter and Gamble is. Just quietly getting it done. Looks like a growth stock, doesn't it? Whereas if you look at Tesla, the run up lately is even less impressive than Procter after the split, but still in pretty good shape. So some of these Dow stocks can surprise you. Let's see. So we got Walmart still at a 2.1 on the auto framer, and Disney at 2.1 on the auto framer as well. Treasuries showing us a overreaction trade, and also 7.4 to 1 on the upside. So as a defensive play, as a flight to quality, Treasuries remains on our little circuit board here. This little breakdown right here is really troublesome because now it puts that entire consolidation zone at risk. However, the last time that it had that kind of sharp sell-off here, it replied with a nice recovery. So we'll be watching to see if it can do the same in here out of that 160 support level. Just three symbols that test out on the auto framer. Again, Treasuries, Disney, and Walmart. That's our mechanical framing data. Here's Procter, 5 3/4 ATRs above its RL 270. And these are the clear front runner winners here: Boeing, McDonald's, Nike, Procter and Dow, DuPont, I should say. Lots of symbols on the daily squeeze test out better than 2-to-1, and that's no surprise given how tightly compressed today's range was. We're starting to see a few symbols now in the summer. I would say keep your eye now on these three. A shift maybe away from tech and back towards the broad indexes. The Russell 2000, mid caps, and then Mexico, all well into the summer. I would look at these three here: 3M, Procter and Gamble, McDonald's, as strong summertime candidates there in the Dow. Lots of big gainers and breakouts. IBM with a nice big move today on some news of restructuring their company to have one half of it focusing on the cloud and AI, and the second half focusing on infrastructure. I think that's a smart move to get some focused attention on the future, which is cloud and AI, while still milking their cash cow for the infrastructure piece. And the market seemed to like that today. Energy had a big day when its past performance, the 30, 90, and 270 period has been bad. Today's breakout was very strong, so we'll see if there's another day of follow through. But otherwise, Mexico was the clear winner today. And the Russell wasn't bad either. And the mid caps. And that's why I'm thinking it may be time for a little cooling off period for tech, because you notice like XLK and the Qs are not as strong right now as the broader mid caps and small caps. So it could be time to make that shift in your orientation. Last thing we'll look at here is the support level that was found here. Looks to be firming up even more. The RL30's slope crossed its 10-period moving average below the dotted line, which is the long-term average. So this actually supports the idea of a next leg up. Could be a nice move. That would be a return to about 355 or 360 if this comes to pass, another move like that. Okay. And that's everything I want to cover for today. I like that the RL30 is making the turn. The RL90 has cooled off a bit. The fact that the RL10 has gotten steep, though, just says respect your stops like we did in PBW today. Be ready to re-enter, but you got to cash them when you make them, right? All right, guys, that's everything I got. I'll get this published and posted on Patreon in the usual way. So thank you so much for your kind attention, and be on the lookout for the hybrid trading home study course if you haven't taken it. I'm going to make that a standalone offer for folks that want to just focus on the workshop and maybe not the monthly subscriptions. And I've decided to freeze the price on the TC2000 for the rest of the year. The response to COVID is kind of disappointing, and until we get a little more resolution on economic stimulus, I think it's fair to keep it at that price level through the end of the year. So there's that. That's everything I got for you. Take good care, and we will see you in the chat room.